So what do you do if you've got spare cash? It's not something that generally happens when you've got a big mortgage, but let's say you've got leftover money at the end of every week or month, and you're trying to decide what's the best way to allocate this capital. Should I just put it into my mortgage? Should I be paying off credit cards? Generally that's the best idea, pay down the high credit card debt. But what if you don't have any other debts? You're not really close to being able to buy another property. Where should you put your extra money? Well, there's a couple of options that I'll suggest to some clients, and just bear in mind that I'm a registered financial advisor. I'm not authorized financial advisor, which means I can't give tailored specific investment advice, but we talk about general concepts here. So one thing that might be worth having a look at is the offset facilities offered by some banks. What this means is, let's say you've got $100,000 of savings, or you've prepaid your mortgage in advance. If your debt's $500K, you got $100,000 in your total money account or your offset account. What that means is you're actually only paying, in simple terms, debt. You're only paying interest on $400,000 instead of the $500,000. So what you want to do if you're paying your mortgages off faster is consider that if you ever want to be able to have the ability to redraw that money, using an offset account is a good way to do that. What a lot of people get caught out on is paying the mortgage off a bit really fast, and the income situation changes and they actually can't get that money back out when they need it. So this is a good option for that. Now, one thing that you should be at least aware of is the revolving credit. So revolving credit is when you've got, it's like a everyday emergency fund, can go up and down. It's like an overdraft that you can use credit cards to pay it off, and if you need to draw down more or pay off extra, what it means is, let's say your repayments are $3,000 a month, but you feel that month you can put $3,500 into it. That gives you that ability, and you've got to check the different banks and the different rules, but revolving credits, it gives you more borrowing, and if you're disciplined, you can use those credit cards, get the rewards points, pay off the debt before you incur extra charges. And if you are looking at extra repayments, like I said before, you want to be able to make sure that if redrawing the money in the future is of interest to you, that you have investigated that. And there's no rocket science to this. You pay more, your debt's going to get cleared faster. But what you want to consider is, if you're making these extra repayments, you might start on a 30-year term. You're making extra repayments. This is how you pay your mortgage off in 17 years instead of 30, or 10 years instead of 30 if you're making the big bucks. But what you want to consider is that maybe after 3, 4, 5 years, you're refinancing from your 30-year mortgage down onto like a 22-year mortgage, and then you're doing the same thing again when you're paying it off faster and faster. So refinancing is another strategy where you get in the cash backs, which you put into your principal. So cashback is like a little incentive. You join a new bank, that money goes into your bank account on day one, and you can use that as an extra contribution towards your principal, which means you're not going to pay interest on that anymore. Now, there's a lot to revolving credits. We're not going to cover it right now, but if you feel like you're even kind of disciplined with money and you're already using credit cards, not such a bad idea. Now, if you've got more than this, or you're thinking, hey, I can make a lot of money in the stock market, or offsetting on 4.5% or 5%, whatever your mortgage rate isn't enough return on capital for you, take a look at Simplicity investment funds. So Simplicity, this is a KiwiSaver investment fund. Now, and what you can do is you can switch your KiwiSaver over to them. There's no commission paid to brokers, and very low fees KiwiSaver fund, and they donate a lot of their profit to charity as well. Now, they also have an investment funds product where if you've got $10,000 or more, you can put money into the passively managed index funds. They're run by Vanguard, which is also a not-for-profit, and you can get spread and draw the money back out whenever you want. very low fee, really good returns in line with the KiwiSaver fund returns. And if stock market's trending up at 8 to 10 or more % annually, then you're getting very good return on that money, which is still liquid in the sense that you can take it back out. And so these are just 3 of many different strategies on how to allocate your money if you've got spare left over. What you've got to do is work with your mortgage advisor, identify which one's going to be most appropriate for you, and there might be a few of them. But what we've seen is a lot of people have savings accounts and they're not offsetting, or they're using credit cards but not effectively using the revolving credit strategy. And basically what that means is the bank is taking your savings and lending your money back to you at a premium, and you're paying tax on all the interest you earn on your savings. And if you're not using the revolving credits smart, then you might be getting the credit card rewards, but what might be happening is you're just consolidating that credit card debt into your mortgage every couple of years, which we see a lot of. So try get on top of your credit card debts. If you need, consolidate them into the mortgage, and then be disciplined as you possibly can with your money so that you can use strategies like this to pay off your mortgage even faster.